Every year, millions of Americans walk into a dealership for the first time. Most of them pay more than they should have, not because they were careless, not because they were naive, because the whole system is built around information the buyer doesn't have and the dealer does. This video is that information. If you're between 16 and 24 and you're thinking about buying your first car in America, pay attention. We're not talking about horsepower today. We're talking about money, where it quietly disappears, who takes it, and how you stop it. Before we keep going, if this kind of content is useful to you, subscribe and turn on notifications. We make videos specifically for buyers who want to protect themselves from bad deals and worse loans. Now let's get into the actual stuff. Here's where things start. The average new car in America costs close to $48,000 as of late 2024. That number matters because it tells you how inflated this market is. Even used cars are expensive. The realistic first car budget for most young Americans lands somewhere between $10,000 and $20,000. And even at that range, there's a whole structure designed to get more money from you than the car is worth. Most buyers think about the car. The dealership thinks about four things simultaneously: the car, your trade-in, your financing, and the extra products they sell in the back office. That gap in thinking is where you lose money without realizing it. Before you contact a dealership, before you even step onto a lot, know what the car actually costs, not the sticker price, not the great deal a salesperson talks about, the real market value. Use Edmunds.com for the true market value, what people in your zip code are actually paying for that specific car. Kelley Blue Book gives you a fair purchase price range. Neither is perfect, but both are dramatically better than walking in blind. If you're buying used, run the VIN through Carfax or AutoCheck. It's around $45, and many dealers provide it free. If they won't, walk out. That's not negotiation, that's a warning. Your target number is the out-the-door price, the final total you actually write the check for. Vehicle price plus documentation fees plus sales tax plus registration. Every other number the dealer puts in front of you is, to some degree, a distraction. When you sit down with a salesperson, there's a good chance they'll bring out something called the four-square sheet. It's a paper divided into four boxes: purchase price, trade-in value, down payment, and monthly payment, all filled in at the same time. That's intentional. When all four numbers move at once, you can't track where your money is actually going. Monthly payment drops, but now the loan is 72 months instead of 60. Trade-in goes up, but the purchase price quietly increases too. The math is designed to confuse. Here's the counter. Negotiate one number at a time. Start with the out-the-door price on the vehicle. Lock that in first. Then, and only then, mention your trade-in. If the dealer knows you're depending on trade-in money, they'll use it against you throughout the entire process. You agree on a price, you shake hands. Then you get sent to a different room, the finance office. This is where the real money changes hands, and it happens after you've already mentally decided to buy. The finance manager's job is not to find you a good loan. Their job is to maximize the profit the dealership makes on your financing. Here's how it works. A lender approves you at 6% APR. The dealer is legally allowed to mark that rate up and present it to you at 8 or 9%. The difference, called dealer reserve, goes to the dealership, not the lender. On a $15,000 loan over 60 months, the difference between 6% and 9% APR works out to roughly $1,200 extra in interest over the life of the loan. That money goes to the dealer. The fix is straightforward. Get pre-approved before you go. Your bank, or better yet, a credit union credit. Unions consistently beat dealer financing rates for buyers with comparable credit. Get that offer first. If the dealer can beat it, great. If not, you already have a better deal in your pocket. Once financing is settled, the finance manager walks through a menu of add-ons. This is where exhausted buyers, tired from hours of back and forth, say yes to things they don't need. Gap insurance is a real product. It covers the gap between what you owe on your loan and what your regular insurer pays if the car is totaled. The problem is the price. Through a dealer, gap insurance runs $600 to $900. Through your own car insurance company, it typically adds $20 to $40 a year to your policy. Same coverage, very different cost. Extended warranties, officially called vehicle service contracts, can cost anywhere from $1,500 to $4,000 at a dealer. You don't have to buy it the day you sign. You usually have 30 or more days, and you can shop independent providers afterward at lower prices. Paint sealant, fabric protection, nitrogen tires, VIN etching. Dealers charge $200 to $400 for VIN etching. You can buy a kit and do it yourself for $20. When a finance manager says these are already installed and acts like they're non-negotiable, they almost always are negotiable. If you don't want them, say so clearly and ask for them removed from the price. If you're buying your first car at 16, 17, or 18, you likely have little to no credit history. Lenders put you in a subprime category, regardless of the fact that you've done nothing financially wrong, you just haven't had time to build a file. A buyer without credit history financing $15,000 might face 10 to 18% APR through dealer-arranged financing. At 12% over 60 months, that $15,000 car costs you close to $20,000 by the time you're done paying it off. The car didn't get more expensive, the financing did. 3 moves that actually help here. Get a cosigner with established credit. It changes your rate significantly. Put down as much as you can, ideally 20% of the purchase price, and apply at a credit union before the dealer ever sees your credit. One cost most first-time buyers completely underestimate: insurance. For an 18-year-old with their own auto policy, annual premiums average between $4,500 and $6,000 depending on your state and what you're driving. In Florida, Michigan, and Louisiana, it runs higher. If you can stay on a parent's policy, do it. It's almost always cheaper. The car you buy affects what you pay for insurance. A used Honda Civic will cost noticeably less to insure than a Dodge Charger or anything with a sport trim. Look up what insurance will cost before you decide on the car, not after. Lowest cost states for young driver insurance tend to be Maine, Vermont, Idaho, and Iowa. If you're in one of those, you're starting from a better position than the national average. There's a tactic that the FTC specifically calls out called yo-yo financing, also known as spot delivery. You sign paperwork, drive the car home, think, the deal is done. A week later, the dealer calls, financing fell through. They need you to come back and sign new paperwork at a higher rate. This is documented deception. The protection is simple. Do not drive a car off a lot until you have confirmed, finalized financing paperwork in your hands, not just a salesperson's word. The franchise dealership is not your only option. CarMax uses a no-haggle model. The price is the price and offers a 30-day return window. Their prices sit at or slightly above market, but for buyers who want to skip the pressure entirely, that trade-off can be worth it. Carvana is fully online with a 7-day return window. Their financing exists, but compare it against your credit union before you accept it. Private party purchases through Facebook Marketplace or Craigslist can save you 10 to 20% compared to dealer pricing. No warranty, no return window, so always pay for an independent pre-purchase inspection. Most mechanics charge $100 to $150 for it. It's the best money you'll spend on a used car purchase. Buying from a franchise dealership makes the most sense when you're purchasing a manufacturer-backed certified pre-owned vehicle, one with a documented inspection and a real extended warranty. Toyota, Honda, and Hyundai Kia run solid CPO programs. If that's your path, the dealership is the right place. If you're buying your very first car, your budget is tight, your credit is thin, and you haven't done the research yet, don't go today. Take 2 weeks, get pre-approved at a credit union. Look up the car's market value on Edmunds. Price out insurance on that specific vehicle before you buy it. Then go. The U.S. car dealership experience is not designed with your interests in mind. That's just the business model, but it doesn't have to cost you as much as it costs the average buyer who walks in unprepared. Know your out-the-door price before you negotiate anything. Have pre-approved financing from your own lender. Decline or negotiate every add-on in the finance office. None of them are mandatory. Read everything before you sign, including the arbitration clause buried in the back of the contract. And if something feels wrong, you are allowed to leave. No car is so perfect that you can't sleep on the deal first. A few hours of preparation will save you hundreds, sometimes thousands of dollars. That money is yours. Keep it.